In our strategy, we focus less on dramatic outcomes and more on sequencing. Markets rarely break when everyone expects them to. They tend to hold together longer than fundamentals feel comfortable, especially late in the cycle. Right now, we're seeing a familiar tension. Asset prices remain elevated, while parts of the real economy are softening. That disconnect feels strange, but historically, it is not unusual. What matters is not whether markets look strong today, but what is supporting that strength. Liquidity conditions, financing costs, and market structure can carry prices even as growth momentum fades. This is why markets can rise while labor weakens. Employment often confirms late. Liquidity and policy act first. That gap between perception and confirmation is where risk quietly builds. In our strategy framework, this environment aligns with Phase 1 pressure. Participation can still make sense, but fragility increases. Narrow leadership, heavy concentration, and dependency on policy support all matter more here. Rate cuts are often interpreted as bullish. And initially, they can be. But the reason behind the cuts matters. Are they easing because conditions are stable or because something underneath is deteriorating? At the same time, market structure has become more concentrated. A small group of large companies can carry index performance while the average stock struggles. That creates the appearance of strength, but reduces resilience. This is where many investors get caught. They focus on index levels and ignore confirmation signals. Breadth, credit behavior, volatility structure, and funding conditions tend to speak first. If you find this way of thinking useful, this is exactly what we do here. We break markets down by signals and phases so you can understand risk earlier, not react later. Subscribing helps you build that framework over time and stay grounded when narratives get loud. A quick note before we go further. This is educational commentary, not financial advice. We are discussing macro signals and probabilities, not giving instructions on what to buy or sell. What would increase risk from here is not a single headline. It would be alignment, weakening breadth alongside tightening credit, volatility that stops calming down, long rates staying high even as policy eases. What would reduce pressure is confirmation in the other direction. Broader participation, credit staying open, liquidity conditions remaining supportive without stress showing up in funding markets. This is why timing matters less than posture. We do not need to predict when something breaks. We need to recognize when conditions change and respond with discipline. Late cycle environments are not about being all in or all out. They are about flexibility, exits, and understanding what is actually driving price, not what sounds convincing. We stay focused on signals, not stories, confirmation, not prediction. That is how we navigate uncertainty without needing certainty. Markets do not collapse because people expect them to. They tend to break when support quietly erodes. Our job is simply to notice when that erosion begins. Until then, participation can coexist with caution. That balance is the core of our strategy.